Welcome to today's episode. We're diving into why investing in real estate in your 20s and 30s is a smart move for your financial future. Stick around to the end and I'll share some insider tips on getting started with little money. For many people, their 20s and early 30s are filled with new beginnings, graduating college, starting jobs, getting married, and starting families. It's also the time when people start thinking about saving for retirement, usually through 401ks or IRAs. But fewer people think about real estate. Many believe it's out of reach, but actually your 20s and 30s are a great time to start investing in real estate, especially passively. Top 3 reasons to invest in real estate. 1. Passive cash flow. Real estate can provide steady passive income. When you invest with a sponsor, they handle the property and you receive cash flow without the hassle. Imagine getting a check every month without lifting a finger. Sounds good, right? Example. Emily, a 28-year-old marketing professional, invested in a real estate syndicate. Every month, she receives a cash flow distribution, which she uses to pay off her student loans faster. This extra income is like having a second job, but without the extra hours. 2. Portfolio diversification. Real estate helps diversify your investments beyond stocks and bonds, reducing risk. It often performs well even when the stock market doesn't. This means your money isn't tied to the unpredictable swings of the stock market. Example. John, a 32-year-old engineer, has a 401k heavily invested in stocks. To balance his portfolio, he invested in a commercial real estate fund. When the stock market dips, his real estate investment still performs well, stabilizing his overall portfolio. 3. Tax advantages. Real estate offers tax benefits like depreciation, which can offset your income. Plus, you can defer capital gains taxes by reinvesting in other properties. This can mean thousands of dollars saved over the years. Example. Sarah, a 30-year-old graphic designer, bought a rental property. Through depreciation, she reduces her taxable income significantly. When she sells the property, she plans to use a 1031 exchange to defer her capital gains taxes by reinvesting in another property. Why start in your 20s and 30s? Time is on your side. Investing early means you have more time for your investment to grow. Real estate is not a quick profit scheme. It grows steadily over time. The longer you hold on to a property, the more potential it has to increase in value. Example. Michael, a 25-year-old software developer, bought a small apartment building. Over the next 20 years, he plans to hold on to the property, letting it appreciate while his tenants pay down the mortgage. By the time he's 45, the property could be worth significantly more. Compounding growth. Starting young allows you to benefit from compound interest. For example, investing $15,000 at 8% interest can grow significantly more over 25 years than over just 5. Imagine your money multiplying threefold or more. Real estate appreciation. Property values tend to rise over time. Investing early allows you to benefit from this appreciation over the long term. Picture owning a property that has doubled in value over 10 or 20 years. Example. Rachel, a 26-year-old teacher, bought a condo in an up-and-coming neighborhood. Over the next 15 years, property values in the area doubled, significantly increasing her investment's worth. The snowball effect. Like Warren Buffett's investment strategy, real estate can grow your wealth over time. The sooner you start, the bigger your snowball can get. Small investments can turn into large returns as you reinvest your profits. Example. Kevin, a 30-year-old financial analyst, started with a small rental property. He used the rental income to buy more properties. Over the years, his portfolio grew, and the rental income from multiple properties significantly increased his cash flow. Learn lessons early. Starting young allows you to learn from mistakes and refine your strategy over time. These early lessons can save you from costly mistakes in the future. How to start investing in your 20s and 30s. House hacking. Buy a multifamily property and live in one unit. This way you can manage the property and qualify for better loans. This hands-on experience is invaluable and can save you money on rent. Ben, a 25-year-old, bought a triplex and lived in one unit while renting out the other 2. The rental income covered his mortgage, allowing him to save more money and learn about property management firsthand. Investing in a REIT. Buy shares in a real estate investment trust. It's a low-cost way to get into real estate without owning property. You can start small and learn as you go. Example. Olivia, a 28-year-old lawyer, started by investing in a REIT with as little as $500. This allowed her to learn about real estate investing and earn dividends without the responsibilities of property ownership. Real estate crowdfunding. Use platforms like Fundrise to invest small amounts in big projects. It's an easy way to get started. Plus, you get to see how professional investors manage large deals. Example: Tom, a 29-year-old graphic designer, invested $1,000 in a crowdfunding platform, allowing him to participate in a large commercial real estate project. He earned passive income and learned about the real estate market. Investing in a syndicate, pool your money with other investors to buy larger properties. It allows you to own a part of high-quality real estate with less money. This is a great way to get exposure to bigger deals that you couldn't afford on your own. Example: Natalie, a 30-year-old consultant, joined a real estate syndicate with a $10,000 investment. She now owns a share of a commercial property and receives regular cash flow distributions. In conclusion, investing in real estate in your 20s and 30s can set you up for long-term success. You have time, fewer commitments, and the ability to take on more risk. Thanks for tuning in. And here's that insider tip I promised. Start by saving just $50 a week. In a year, you'll have enough to make your first small investment. Happy investing.